Good day, friends. This is lesson number 16, and now I want to talk about option expiration. It is very important. I get a lot of questions about this procedure. So I decided to tell you about all the nuances so that you can understand such an important topic. Thanks to the expiry, you fix your financial result. As you know, each series of options has its own expiration date. On the AE exchange, the Bitcoin futures have options with different expiration dates. They are weekly, monthly, quarterly series. Any expiration occurs on Friday, no matter if it's a weekly, monthly, or quarterly. Friday, 8 UTC. What happens at that hour? On the AE exchange, the expiration is real. Not like on some other cryptocurrency exchanges, where you just get air. Someone, somewhere has calculated and fixed the financial result for you, and you end up not getting the base asset of the option. On AE, you get the real base asset, the futures. So let me explain it now. If you have in positions, for example, purchased call options, then in this case, if the strike price will be higher than the futures price, the option goes into the money, the option is exercised and delivered strictly on the expiration date. Since there are many futures traded on the AE exchange, such as Bitcoin futures, Ethereum futures, child of the Polygon project, Matic, Dogecoin, the expiration price is determined for each futures at 8 UTC. The price is defined as the average value of trades for the last 10 minutes before expiration, and at this price, the options are executed. If the price of the bought call option is lower than the strike price, the futures are delivered at the strike price for the bought call option. If you have sold call option, then with the expiration date, you will get short of the futures of the sold call options. If we have put options, everything is different. Let's imagine we have a put option with strike 25,500. The current price is 26,176. If the price falls below 25,500, this bought put option will go into the money and the short futures will be delivered. The bought put option will have a long futures delivery. For this example, I will take an option in the money of strike 26,500. I will change the date to next Friday, the expiration date. A trade will occur and we will get a short of the futures, the same number as the contracts we bought. If we are working with sold put options in the money, the futures price will be less than the strike price. After the expiration date, delivery of long futures will occur. If you have synthetically closed positions, for example, you have a bought call option and a sold put option of the same strike, 27 for example, then you have a synthetically bought futures. Now look, if you sell the futures, you have a synthetically closed position. Let's say your put options went into the money. You bought call options and sold the futures, turned it into synthetic. On the AE exchange, at the expiration date, your entire position will collapse to zero. On other exchanges where there's no delivery, you won't have the position collapse, and you'll be left with the futures. That's the problem. Be careful when you trade on an exchange where there's no deliverable expiration. In this case, your synthetic positions will not collapse. I recommend that before each expiration, you look at your positions carefully. Analyze and figure out how many futures you're going to end up with. And before expiration, you can buy or sell that number of futures. Expiration happens and your position is collapsed. Very convenient. Now I want to demonstrate the actual expiration. First of all, there's a notification at the expiration date at the Telegram channel and AE terminals. You can always open this information. Look at the prices of the expired options. So now look at the last expiration on the August 18th. At the bottom, you can see information about the trades. Let's say we bought call and put options at strike 29. There were systemic trades to sell these options. The call options were out of the money, the put options went into the money. There was a sale and delivery of the futures, and you can see all information about which price the trade ended at. In the end, there was a delivery of 10 short futures for that price. The next trade is a 31 strike call option. out of the money expiration. Put options of strike 28 are expired in the money. Therefore, 50 futures are delivered at strike 28 price. You can see all the information about the trades executed in the account history window. I recommend you go to this window after the expiration and analyze at what price and what was executed. Delivery occurs in weekly and monthly series of options. But the quarterly series has one peculiarity. There will also be delivery, but since the expiration of options and futures happens at the same time, the options will be delivered first, and then the futures will expire. Once again, I want to advise you to check your options before expiration. Some strategies have a risk that after expiration, the number of futures may exceed the margin requirements. If this is a possibility, be prepared to deposit the necessary funds or swiftly close the position. Otherwise, you will get a margin call. This is a rare situation, but it can sometimes happen with strategies such as straddle, butterfly, where margin requirements are low, but there's a possibility of a large number of futures being delivered. And that's all I wanted to tell you about option expiration. If you liked this video, please give it a like. If you have any questions about options expiration, write it in the comments. I will try to answer them all. Subscribe to the channel on stock trading. I wish you good luck and successful options trading.